Yeah, good morning. This is Ken at Tortoise Capital with Luis. We're reviewing some background material about how to best read and use the daily report for constructing tomorrow's trading plan. Um, I'm going to be concentrating in this one on the intraday trades. Um, and so I want to get my mindset recorded before I get to the report. When I do get to the report, for those of you keeping score at home, what I'm going to do is take this weekend's report, uh, January 17th, 2026. I'm going to go through that thing systematically. I'm going to make notes about what I see, about the markets, about volatility, about swing trade opportunities, day trade opportunities. And what I'm going to do is I'm going to be looking for three different categories of symbols. The thing that I prefer to trade tomorrow is something that is already a live trade for me, meaning that I traded it yesterday successfully, and I may have carried a piece of that day trade overnight, but it's going to be a continuation of the previous day's move. And that's my highest priority because I've already committed myself emotionally and rationally to understanding that trade. I feel like I'm dialed into what that trade wants to do, and I can minimize the amount of new research that I have to do. So uh, there's an efficiency uh, and a commitment to that. What I'm going to look at today are I've got trades active in silver, Palantir, Unusual Machines, NVIDIA, this LAC. They're a lithium company. The leveraged Google exchange traded note, and then Caterpillar. Most of those, no, actually, all of them except LAC have swing trades associated with them. So there is a there's a swing trade that is long term, and then as long as this thing keeps going up, each day in the market where I see a favorable opportunity, I add a turbo trade intraday and I close that position out each night. But because I'm invested in the swing trade, I'm doing the prep work on it anyway. And these things all have enough volatility that they are tradable intraday, that there's an efficiency in trading the continuations. And Luis, on behalf of the people, if you need to raise your hand, ask a question, just jump right in. It'll be fine.
Yes, sir.
Okay. The next thing that I'm going to look at is, as I go through the chart, is I'm looking for any new signals or new patterns that just hit today. Um, and the reason for that is because this looks like it's probably something that occurred at a turning point. Because most of my signals and patterns on any time frame are being triggered by price action that changes at support and resistance levels or after an abnormally large move. And the reversal of those large directional moves uh, is an excellent trade. But it may also be that uh, that large move might continue in that same direction. So there's like a what I call the compound critical state. So if there was something like a big sell off and it terminated in a doji, maybe two dojis. Now, instead of that thing continuing downward, there's some evidence occurring that, hey, this thing is getting sideways. Now, from here, I can imagine how this thing could return to whatever the previous level was when it started the failure. I can imagine how this failure was an overreaction. And so the people that owned this thing up here saw it as target of value, but then they just got surprised by this big sell. So there's going to be some motivated buyers that want to buy it on a dip. And if they start buying it on a dip and it starts moving up the stack, then it looks like a buy on dip. And that could bring in more momentum traders. And then there's a 50% retracement. And then the thing has its own momentum. And this would we would call that a reversion to the mean trade. And it's not unusual for that thing to get back to the mean and then that momentum continue it for another leg up, particularly if the previous move was a big move up to a peak and then it sold off. So that's your classic buy on dip. We have a system called the Kata 2 that looks for that. We look for things that have the strongest RS, relative strength, and then the stronger that move was relative to the other moves in the market, the greater the likelihood that a pullback will be seen as a buy on dip opportunity and then a continuation. So I always look for those. By the same token, if instead of this being a strong relative strength up move, this could have been a strong down relative strength move, and then it collapsed further, and now it gets to this hesitation point. Now, if the buying pressure doesn't come in, or even if just a little bit of buying pressure comes in, that starts triggering people that look for this as a dead cat bounce, and now they can get short something that is horrible, and now they want to get on board with that. We might use a Kata 2 to the downside by getting short just as soon as it starts rolling over, or we might wait for a break of the support level with a collapsing dragon and try to enter in here. So I say all that just to say that we have a collection of swing trade patterns, which give us a confidence that if I have something like 5 days down, as an example, that's our 5DD, five lower closes, that's unusual behavior. And then we've discovered that if we put a frame around that last daily bar, that if I buy a breakout of yesterday's high with an initial stop below yesterday's low, and we would call that the yellow zone, and if I use that as a 1R risk, it may be that if I go back to the 10-day high, which would have occurred somewhere higher than those 5 days down, if I used the 10-day high as a standard reference point and I use the daily bar as a risk box, if I can see 2 units of reward back to the 10-day high, I could claim that that is a 2-to-1 reward to risk ratio, and I could trade the breakout. Similarly, if this thing breaks out below yesterday's low, then I'm pretty sure there's going to be another 2R move available to the downside on a swing trade basis, precisely because there was something that we've already seen that's making this thing drop 5 days in a row. So it's not hard to believe that tomorrow could be the 6th day down and the 7th day down. Sometimes those 5DDs become 10DDs. So for us, the 5DD pattern is an ideal swing trade because it gives us a positive expectancy when trading the reversion to the mean. The failure trade gives us a positive expectancy. And as long as I don't have a directional bias, it can be possible for me to just follow price. Now, if I can do that on daily charts, and if that swing trade that works lasts something like 5 days, that swing trade could be open. What I really have is on day one of the trade, uh, it took out yesterday's high, and now maybe I have a 1 day good performance. If the day after the signal is a strong directional move, then I have reasons to believe that this thing could keep going up for 5 days ish before it gets back to the previous swing trade, a 10-day high, I should say. Well, what that means is I now have reasons to believe that the direction of the day is not a coin flip. And I could interpret intraday price action that's moving up as a continuation of the swing trade energy with more people coming into the trade. And now I have a reason to treat this as a directional trade and not just as a random number. So this is the basis for the core and turbo trade, where the core position is the swing, and we use a swing trade risk box to protect against noise. And as long as that swing trade is open and moving up, then each day I can take as an opportunity to trade in my favorable direction on a symbol that I've already invested some time and effort into analyzing. So when I say that I'm interested in uh, continuations, what I mean is that I already have a swing trade. I already have a swing trade in these things. And if it starts moving in my favor the next day, I know immediately how to trade it because I've been paying attention to the chart. But also, if it's a new signal or a pattern, like a swing trade pattern, like a 5 day down, or a washout pattern, or a channeling pattern, or a triple screen pattern, or a 551W pattern, um, I can trade. I can look at the swing trade, and then the next day, if it starts behaving like a swing trade should, I could trade it. Now, what would that look like? Well, if the pattern again was the 5 day down, and I put my yellow zone box around it, what that means is I'm going to get long. We call this the mechanical entry. I'm going to get long 5 cents above yesterday's high because now I have new information that tells me that the buyers are coming in, that there are people, if this breaks out, that tells me there's people that are coming in to buy it higher than yesterday's price. That is more positive psychology than there was yesterday. So a breakout from yesterday's high is new information and is confirming the hypothesis that maybe this thing's going to come back to the 10-day high. So that would be my swing trade pattern. That would be my swing trade entry. Now, how far could that move intraday? Well, we know that the max reasonable intraday move is a range stat. A range stat is the average range of the last 30 days plus one standard deviation of that range. So how do we compute that? Well, we take day minus one and day minus 30, and we get the range percentage of each of those 30 days, which is high minus low divided by closing price. And that gives us a percentage. And so we can take the average of those, And then if I range that from largest range to smallest range, I can find the average and then plus or minus one standard deviation. And then I know from math that two-thirds of these ranges are between plus and minus one of the average. And so the smallest range I could expect would be either the smallest range of the stack or no movement at all. And then anything greater than one standard deviation greater than the average, this would be unusually large range. Now, we know from math that if two-thirds of the time those ranges are between average and plus or minus one, we also know that about one-sixth of them are greater than this, and about one-sixth of them are smaller than that noise box. So, as a matter of definition, we say that the average range, we say that the average range plus one standard deviation is the maximum reasonable intraday move, meaning that the move if we add up the percentages, this is about 15%, and that's about 67%. It turns out that that's about 85% ish or 84%. 5 out of 6 times today's range is not going to be larger than average plus one standard deviation. Only one time out of 6 is today's range going to be larger than that. So what we use the statistic for is to say that the upper limit of our move intraday could be a positive range stat or it could be a negative range stat. So when this thing opens, so if I'm stalking it and here's the opening, regardless of the gap. Here's where it closed and here's the gap, the open. At the start of the day, I'm allowed to say that the normal expectation is that it could go from the open as high as a plus range stat or as negative as a minus range stat. And that when the final closing bell hits, this thing might have gone up that far and down that far and been here. And now I can measure the size of that move for the daily range. And 5 out of 6 times, it will be less than a move from zero up to the range stat. So that gives me an estimate of how big this move might be for engineering purposes.
Hmm.
Are you with me so far?
Yes, sir.
Okay, good. So now, if I am primarily a swing trader, all this is kind of interesting, but not really all that relevant because all I need to know is how big was yesterday's bar and what was the high and the low so that I can construct my yellow zone risk box, check or hold.
Check.
And then I know the mathematical entry in either direction because I'm ready to play this to the long side or the short side. The size of the position, the dollars that I choose to risk,
Hmm.
I might say, hey, let me also take a look at market conditions because the symbol that I'm using is strongly correlated to the market. If the market was in a bull market, I might
Hmm.
be willing to put my full load on that because now I'm trading in the direction of the primary market. I'm going to get a boost. If the market was in a bearish condition, I might only put half a position on this because while the market is selling off, this thing has to reverse against that trend. And so it will be harder. The
Hmm.
psychology will be against it. So maybe I don't take as much dollar risk. The architecture and geometry of the trade frame is going to be the same, but I might be using market condition as a way to vary how much money I'm willing to risk per trade. So
Correct.
that's an important idea. So now I want to trade. If I want to trade this more aggressively than a swing trader, I might do the following. Let's remember. So the date or the swing trader simply sees his pattern, frames the trade using the daily bar, uses a return to the 10-day high as a reasonable price target that it could achieve over the next 5 days. Probably won't make that in one day. And in fact, the biggest I could ever hope to get was, what if it opened right at my preferred mechanical price and then made a range stat move to the top? That would be the most that I could reasonably hope for. And it might be that those 5 days down constituted two full stacked range stat moves. So it would be unreasonable for me to think I could get that all in one day. So what that means as a swing trader is I've got to have a wide enough stop so that I give this room to breathe as it's climbing up within its normal channel so that these normal kinds of noise moves don't take me out. But as soon as this thing actually starts to fail and is telling me that this is a negative signal, then I should be able to get out. So where I place that trailing stop now becomes a matter for some judgment. And where I place that stop is not, it has nothing to do with how much money I put on it, but it has everything to do with the time frame that I'm trading and the size of the appropriate box. If I'm on a swing trade, I might use, if I'm being aggressive, I might use a full frog box. I might use yesterday's range, which was how I initially computed a risk of 1R in order to gain two potential R's. I need to see at least 2 units of reward against the 1 unit of risk to justify the swing trade. Once I see that, I can then say there's enough in this to get 2 versus 1. I might actually have a wider stop and I'm still willing to take it. Or I might have a smaller stop, which says I don't need to see a full 1 day rejection of my trade in order to get out of that trade. And so I might be able to have a larger position size because what I'm going to do is risk a fixed number of dollars, compare it to my exit criteria, and then use that to govern the size of my trade. The point I want to make here is that for the swing trade, the reasonable move is a return to the 10-day high. That's the maximum reasonable move. On the intraday trade, a movement from the low of the day to a +1 range stat is the maximum favorable move that I could expect, or if I were short, from the open to the downside. So depending on the time frame, the expectations of how far this thing can move will vary. And those things are being computed statistically so that I have a certain edge against people that are trading this thing emotionally. All right, so far so good.
Perfect.
All right. So now let's see how this works out in practice. So I've got my 5 day down. There's my open. Maybe it gaps down to here, sells off quickly on 1 minute bars, and then gives me a 1, 2, 3 entry. So a 1, 2, 3 entry on the intraday, because now what I'm going to do is the following idea. If I know as a swing trader that here's where this thing closed on a 5 day down, and I know that no matter where it opens inside the yellow zone, that if this thing passes through yesterday's high,
We're long.
Yeah. So I want to be long right here, no matter where it opened inside of this. And I know that my risk box as a swing trader could be right there if I was using a 1 day range. Now, it may be that this was a tiny little doji and that's really close. And so I might want to use a 1 ATR. So I will always compare a range against the ATR against 2 ATR. So my swing trade risk is usually one of those three. And the reason for that is the size of the previous day's bar. If that was a large if that was a large range, like a full range stat, and let's say, it opened here, went all the way to there, and then came back to here. Amazing. There were two range stat moves in the whole day. And now the next day happens. And here's my price that I'm going to get long, and here's my price that gets short. It's already a range stat move. Let's say it opened and there was no gap and just starts moving up. According to the swing trade theory of that trade, I don't have any new information until it gets above that price level. Check.
Okay.
And that's where I'm going to get long. So that means I have to tolerate this thing moving a full range stat, and then I can get long. So what I came to understand was, as a guy who wants to day trade more, I realized that if I knew where the low of the day was and when it opens, it is simultaneously the low and the high of the day. And I know that it could move a range stat up and a range stat down. And I know that because the previous move was 5 days down, that if it violates yesterday's low, I want to be short instantly. So here's a case where if it opened right here, the amount of risk that I actually need to take is this little box. Because as soon as it violates this price, I want to be short. So here's something that I could do. I could wait for it. Now here's going to be the price. Maybe it's a 1, 2, 3 on the intraday. And now I could buy it right here because it has given me a favorable 1, 2, 3 entry. And I know that that quite often can be useful. I could say I want to take a 1, 2, 3 entry and use this purple box as my actual decision box, my risk box. And all I'm saying with that is that if it goes below this price, I'm going to be short with a collapsing dragon. Check or hold.
Check.
Now here's where guys get into trouble with the way Tharp used to describe the how to compute your position size. He just said if that's where you were, if that's the price that tells you to get out of the trade, then that's going to be your 1R. I do not disagree with that idea because I want to be able to express how many units of gain I get based on how much risk I was willing to take.
Right.
But here's what I'm also going to say. If I know that I've got 2 to 3 frog boxes from the low of the day to the high of the day, because I can fit 2 to 3 frog boxes into a range stat, I don't actually even need to use the computation of the risk box to calculate my risk to reward. I know that as long as my decision box is less than a frog box, I'm going to easily have a asymmetrical reward to risk. So in this case, what I actually want to see is I'd like to see 5 days down that terminated in a tiny little doji so that I could be long or short with the minimum amount of time spent in the yellow zone. But what I may want to do for position sizing is use a wide standard frog box and say that's the amount of risk that I'm protecting against. So here's a case where maybe the doji was 30 cents and maybe the frog box was $1. And then if I'm going to use $300 of risk per trade, I could take if I was going to use the size of that little doji, I could get 1,000 shares, but then the probability that it fails fast is great. So I'm going to take a more likely loss on a huge position size. Whereas if I just use a frog box normal, I would still get out where the pattern told me I should get out, but I'm not going to sit in there for a full frog box against me because I already received a signal that said the long side trade isn't working. In fact, the short side trade is working. I don't want to wait to see if it gets all the way down here in order to get on board the short. Because if this was 0.3 and that was 1.0, there's a 0.7 move that I'm just watching it fail in the direction that I expect it to fail. On the other hand, if I'm going to use the frog box as my position sizing, I don't want to let this thing get a full frog box off the low because the 1, 2, 3 gave me a reason to believe that this thing could be working, that it found its low of the day quickly and has started to reverse. And now maybe it breaks out above the open. I don't know, wherever maybe it breaks above the open. But I have some, as this thing finds the low of the day and then starts moving up the stack, I could get in on a 1, 2, 3. I could take a hybrid frog box and say, if it moves half a frog box off the low, I'm ready to get in. If I looked at where the PSAR dots were declining, and this price passes through the dragon and hits the PSAR and reverses, I could get long there. I could get long on a full frog box off the bottom. And it's simply a question of how far up this stack of confidence I want to wait before I actually get in. The price that gets me out is always going to be a violation of yesterday's low. So the question is, how much adverse price action am I willing to tolerate before I get out? But what I'm going to tell you to do is use a full frog box as the limit of your position sizing, because that's going to allow you to try these smaller boxes, but without supercharging the size of the position. So you take huge losses fast. You don't want that. Are you with me so far?
Yes, sir.
So, what I'm going to say then is the way to think about this is that when you get your entry, as long as you had some upper level price that was the low of the day, plus a range stat, you know that's your maximum upper limit of the day. And if I know that that's always going to be 2 or 3 frog boxes of size, it actually doesn't matter. If I got in on a 1, 2, 3 right here, and I was using a full frog box to protect against catastrophe, I would still get out here below the low of the day. But now my loss is only a 0.3. And then if this was a 3.0 frog box up, my win could be 2.7 compared to the frog box worth of risk. And so if I get an entry at zero point 0.3 off the bottom, I still get a large move. If I waited for a half a frog box, I'm still getting a 2.5. If I waited a full frog box before I get in, I'm getting 2.0. So in terms of sort of, and if this is all based off of a standard position size based on, say, $300 divided by a $1 frog box, each one of these entries is always the same size position. Like, I don't want to take this one at 1,000 shares because this is the one that is most likely to fail. In fact, you actually want to see that fail because what that means is there was a little bit of buying pressure and then the shorts came in and pounded it, and now it's off to the races to the downside. So you don't ever want to wait longer than yesterday's low. So the closer to yesterday's low you buy it long, the greater the likelihood that normal noise will take you out. And you'd rather take that on 300 shares rather than 1,000 shares. Check or hold?
Check.
But what you know is that if you entered anywhere inside this range on 300 shares and you get a range stat move or even half of a range stat move, you're good to go. You just made a standard unit of reward, a brick. And the difference is your the R return of that was either, 2.7, 2.5, 2.3, or 2.0. And then over the long run, when you total up 30 trades like that, you'll find out what your expectancy is using this standard geometry, but you're not going to ever, in this mode, you'll never take a full 1R loss because you were taking less than a 1R risk box that was based on the architecture of the trade that you're taking. But it's always a firm fixed price about where you're going to stop and reverse. Now, some people would say, hey, given the fact that this was a 5DD, why don't you just wait for it to fail? And I would say, yes, you could certainly do that, but the 5DD that buys this thing long is positive expectancy. And it's positive expectancy if you wait for it to take out yesterday's high. Maybe yesterday's high could have been here. And if you wait for it to take out yesterday's high, that leads to a swing trade that is positive expectancy. So what that means is as this thing was moving up the stack, you had opportunities intraday to take that trade. Check or hold.
Check.
And if I want to be a day trader, what I might do now is just say, give me the swing trades, and then let me just trade this one day at a time with no overnight risk. And as long as the original swing trade hypothesis is still working, I don't have to take any overnight risk. I could just wait for the new day and say, well, this thing is still on its way. It hasn't reached its 10-day high yet. Or even if it did get to its 10-day high and is continuing, but never hit my trailing stop, then this is just continuing to go. I have a continuous signal that says you should trade this thing long intraday as long as you get favorable patterns intraday to the upside. And then all of your research is done. Check or hold.
Check.
So now I want to say the size of yesterday matters a lot. What I don't want to do is trade normal. I would really like to see yesterday was a huge range or yesterday was a tiny little doji. Now, it turns out that if you're using a hybrid frog box, and let's call it 0.5 as your as your unit of decision. And if I had a range stat that was exactly 3 frog boxes, what I really have is 6 little hybrid frog boxes inside my range stat move. Check.
Check.
So what if this thing, here's your 5 day down, and here was the yesterday's low of the day and yesterday's high of the day. That was a tiny little doji. It's pretty clear that I cannot trade inside the yellow zone. Let me get my yellow color just a minute. It's pretty clear I cannot trade inside yesterday's candle. Why is that? Why is that clear? I say it's clear, but it's only clear if it's clear to you.
I mean, on a swing basis or on an intraday basis?
Intraday.
Um, no, it's not clear why you shouldn't be trading that on an intraday basis. I
Yeah.
think that once it becomes a 5DD, it actually becomes a high quality candidate to then
Right.
become an
Right.
intraday
So
trader.
yeah, so the mechanical entry has me buying it outside of yesterday's range.
Right.
So I'm not trade even if I enter this as a swing trade,
Uh-huh.
I'm not I'm not trading inside yesterday's candle. I actually had a price that led me to believe that today is not being constrained by yesterday's price action. Think of yesterday's price action as the maximum amount of stretch that these guys could tolerate. Like they could not, the buyers could, there was nobody willing to buy it above that price yesterday.
Mm-hmm. Mm-hmm.
And everybody was willing to buy it above that price. So the sellers were just selling it to them.
Right.
Uh, so if nothing changed in the psychology of the traders or in the economy or in the market, then we
Mm-hmm.
would reasonably believe that price today would be contained inside yesterday's yellow zone because nothing changed in the market about their psychology. You still wouldn't have anybody willing to buy it higher than the high or sell it lower than the low, if I can say it that way. Right.
Okay.
But I now have a piece of evidence that no matter where it opened, the buyers were willing to buy it at a higher price. So I can infer that something changed in the market and in the minds of the buyers who were willing to pay a higher price.
Oh, sorry. I get it. Not what you're saying.
Yeah, yeah.
I was confused about the 5 days. So the this is the doji actually happened on the 6 day. So the 6 day, based on the 5 day down, the 6 day
Yeah.
you have
Well,
you have it.
the doji could have been the 5th day down. I didn't draw that very cleanly.
Oh,
Let's
okay.
say
All right. All
this.
right.
Let's say this was a low, or that was the close and the close and the close and the
Yes.
close and
Yes.
the close, and this thing, the doji, also closed lower than the previous day's close. So that's the 5th day of lower closes, but it also happened to be a doji.
Okay. All right.
So when it's a doji, this is actually the doji is the best possible previous day's bar in a 5DD
Right.
because that's the smallest daily range of recent history, you know, and it gives me the minimum amount of indecision so that as soon as it goes below that low, I don't have to wait. I can be short.
Right.
And I don't, as soon as it goes above the high, I don't have to hesitate. I can be long.
Right.
Think about the change in psychology that is represented by a maximum pain sell off or a 5DD or red Niagara or just some kind of just horrible selling Everybody knows this thing is terrible. Nobody wants it. And there's large red candles all the way down. It just, ugh, hate it. And
Right.
then on this day of the doji, instead of it being a large range, it's a small range, meaning that the buyers and sellers were locked together very tightly, making their exchanges quickly.
Right.
And it went from a massive panic sell off to a draw in a
Right.
tightly constrained area. What that really means was, especially if there was heavy volume, that would be amazing. Because then you had an enormous changing of the guard, that you got everybody that was short covered their position. That's where the buying pressure was coming from. They were getting out of their shorts, so they had become buyers. Plus, you had some other number of buyers, and all the guys who had been sellers ran over and became buyers. So now you get this equalization in and around the doji. It's like a maximum tension of uncertainty. And then it breaks out to the upside. The price I have to see that tells me the psychology changed was a price 5 cents above yesterday's high,
Hmm.
which means I can't trade inside the yellow zone. So now I want you to compare that idea. What if yesterday's doji, or yesterday's price was a large range?
A large range.
Yeah, so it went down, 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 down. And then yesterday was this. It opened, sold way off. Hey, and maybe it closed near the bottom of that range. That would be awesome for the short side because I know now that as soon as price crosses that line tomorrow, like as I'm thinking about it, what if it opens where it closed? The distance to the price that tells me it's going to continue is very small. Check or hold.
Check.
Yeah. The distance it has to travel to tell me that maybe the red Niagara is over is very far. That could have been a range stat or a double range stat day. So let's say this thing closed where I'm showing you and it opens exactly where it closed. And you know that you want to buy it here because you know if it goes to the 10-day high, even with this size of a bar, it's got two of those bars up to the 10-day high. So once it clears this hurdle, you're going to have a good trade, right? So now
Right.
there you are intraday. It opens, it sells off a little bit, and now gives you a 1, 2, 3. And now it's rising and it's above yesterday's high. And this, you look at this and you say that now for 2.5 years, I used to just wait and watch. And then if it got here, I would buy it.
Go long.
And then the swing trade was positive expectancy
Right.
because this is actually the kind of a bottoming candle that is not surprising at the end of a disastrous selling period. And everybody realizes, oh, this is a buy on dip opportunity. And for the long run, they just implement a buying program and it just grinds its way back north. But what was irritating to me was how many times I would watch it move from this little 1, 2, 3 up to the daily high, and it was a range stat. And I'm thinking, hell, I just watched it move 3 or 4 of my little
Possibilities.
hybrid wrist boxes in a straight god darn line intraday with no overnight risk. And then in the last hour, I saw myself buying a swing trade 5 cents above the high.
Right.
That just, it was like,
Painful.
oh, well, yeah. I mean, but not until I started looking at it as a day trader.
Right.
So what I realized was that I could have a 5DD as a swing trader, and I could be very content. Like if this is a 5DD that terminates in a doji, that's the one that drives the swing trader nuts because he's buying it here. And if you went strictly by what Tharp was teaching, you'd put your 1 hour stop there. And many times it would fail. And tomorrow could actually be a positive day. It could have done this, but you got, or it may have done this and then did this and did that. So you end up getting chopped out of that a couple.
Whipsawed. Yeah.
Yeah. So the way I resolve that is I say, look, no matter where inside this stack I'm going to buy it, I'm going to, if the frog box is wider than the doji, I'm using the frog box for my position size. And you could even say, hey, look, I'm going to use 1 ATR, which is a better answer. I'm going to use a standard 1 ATR as my position sizing box. But what I'm going to do, so that limits the size of the shares that I can buy, because I'm going to take $300 or whatever it is, your risk per trade, divided by the ATR, and that's going to give me the size of the position. I want to buy it here, and what I'm going to show you on it, when this is a large candle, I might buy it sooner than the breakout. Uh, and then I can tolerate a little bit of noise, but only to here. And then I'm out as a day trader. As a swing trader, I can give it that much room because I have a reasonable belief that over the next 10 days, that thing's going to make that move. So I don't have to get too close and too large. The reason I have to get out fast intraday is when my position size was too big to handle expected noise. Check or hold.
Check.
All right. So now here's the last day in my pattern. Now what I want you to realize that I've been using the 5 day down.
Mm-hmm.
This is the last day in any of those swing patterns.
Right.
Because on all of those mechanical swing patterns, our standard framing to determine if there was a good reward to risk was said, if I got in there and I got out here, and treated that as one tentative 1 R, is it 2 R to the 10-day high? And our rationale is that swing traders have about a 2 week memory, and they remember where the 10-day high was. And everybody that owns that thing, remember, if we're buying things that were high relative strength and they got to a 10-day high, on the day it made its 10-day high, everybody thinks that's the fair value until it gets up to where I want it to go. They think that's where it should be. So now every time it sells off a little bit, there's a certain region, there's a certain amount of sell off that they're willing to tolerate as noise and say, hey, this is, sorry, my pen is lagging a little bit. They're going to see there's a certain region in which they see pullbacks as the normal noise, in which buy on dip is the right answer. Hey, that's what we say is the Kata 2. In the Kata 2 pattern, what we say is that the dragon, the 10-day simple moving average, plus or minus half a standard deviation, that the price has to come down through the dragon and then reverse back up through the dragon That's where my kata 2 is. I have to see that before I can re-enter. And this low that the Dragon makes, or I'm sorry, the RL10 or the Dragon, has to be higher than the last time it sold off and then resumed. So if I
Right.
had a low and a higher low, and now prices cross the Dragon, I can enter in this little pocket before it breaks out to a new high. Once it breaks out to a new high, then all the buyers say, aha, we confirmed that this was just a buy on dip. And now, with great relief, we can come in and buy the breakout. So the COTA 2 is a statistically based entry that saw a short term reversal of momentum back in the direction of the long term. The sell off was contained within the noise channel. And now we're going to buy it as the second mouse, anticipating that the third, fourth, and fifth mouse are going to rejoin it as soon as it breaks out so that they can get on board this long, powerful trend. So that is in general how we approach on any time frame buying a continuation pattern in the direction of the previous strong, non-controversial move. So what that means then is each of our swing trades had some kind of previous move which said that terminated in the last day of the pattern, usually a sell-off, like 5 days down was 5 days of continuous lower lows. The triple screen was close below the 20-day moving average and then cross the 20-day moving average with a 2-to-1 with a 2 ATR move available to the 10-day high. The washout pattern was simply uh, let's see, it went to oh sorry, it went that should be a box. It went to oversold on Williams percent R. So we bought it simply because it went into oversold. Because on the way up, it's rare to see that thing get to oversold. But whenever it does, the buyers recognize this is quality on sale and they come in and quickly buy it. So there was a sell off in channeling, or that's, I'm sorry, channeling. In
That's
washout,
handling, yeah.
yeah, in washout, it's slightly different. There was a horrible sell off on everybody thinks it's horrible, and then there were too little days of continuation possible to the upside, and so we buy the next day breakout with a tight risk box, and we get out of that as soon as it looks like it's going to fail. And then what we're hoping is that this is a long series of COTA twos, each one of which we evaluate in the same way that I just described.
Right.
Uh, the snapback says there was a thing that was this huge positive, but then there was an adverse gap well outside of the noise, and that is probably an overreaction. That there was some adverse news event, and it's going to sell off that day, and then close, and then cooler heads are going to prevail, and they're going to come in and see that as, oh, that was a overreaction against bad news. And so the day after that, they're going to start coming in and buying it back up to the previous high. So every one of those mechanical swing patterns, and even the 551W says this thing was up for 5 weeks, down for 5 days. It's below the 5 day high. It's higher than it was 25 days ago. And today was a white candle, meaning guys held it overnight in an advanced position, and we're going to buy the next day. So every one of those featured something like a adverse move that created a noise channel, and then we saw confirmation that price was going to resume the long and strong, the only exception to that being the washout pattern. And
Mm-hmm.
so in the swing trades, then I can always just wait for it to break out above yesterday's high. But again, what if I am comfortable with a 0.5 wrist box, and I'm position sizing with a full frog box. What I could actually see is I could see this open and sell off, never take out yesterday's low, but it was kind of a quick reversal.
Hmm.
And then it moves zero point 0.5 off the low of the day. And I look at this and I say, based on the size of yesterday's rate, I know that it could move that far in one day. It did that yesterday. So
Right.
that's not a leap of faith. That's the most recent evidence.
Right.
So I could look at this and say, just on the basis of it moved zero point 0.5, I don't even care what the price pattern was. Just zero point 0.5 off the bottom, I could enter and I could go. And then what I do is I hope it gets this far. But what I'm going to do is I'm going to say, look, as soon as this thing gets 1R in hand, or in other words, it moves up zero point 0.5, I'm just going to arbitrarily say my stop, my execution stop, which was here, check.
Hmm.
I'm going to
Yes.
move that to no lose plus dinner for two. Sorry, my pen is slow. That should read no lose plus dinner for two. Okay.
All right.
Now, if it gets to a full 2R, in this case, one, all it had to move was one full frog box because I got 0.5s in here.
Hmm.
I'm really holding 2R compared to my risk. This is where the idea of keep 70% is going to be your friend.
Correct.
This is the most important thing I'll say all morning. Keep 70% of your maximum favorable excursion once you get past 2R. What does that mean? That means this thing could come back and exit you at 0.7. Okay.
Yep.
0.7 of a frog box, I should say, which turns out to be about 1.4 R compared to your initial risk. You will take that all day, every day. And then, oh, by the way, if this thing gets to here,
Which is the size of the hybrid frog. The point 0.7 is exactly the size of the hybrid. No?
yeah, yeah, yeah,
Exactly.
it's a 0.7 of a frog box is
Yeah.
1.4 of your hybrid frog. And guess what happens if this thing came back and you were low ticked
Hmm.
and then it broke out higher? You still have two hybrid frog boxes to the upside just to get to yesterday's high.
Right.
And so that's your COTA 2 reentry,
Right.
and you take that in two bites. And then if this gets above yesterday's high, you got the first piece of information that new buyers have come in and are buying it at a higher price than yesterday. You could actually add a position there
Right.
and call it your swing trade position. Or you could just simply say, if I have, let's say you ended up getting 500 shares on this with your intraday positioning. You could just get above this and say, you know what? I actually want to, I'm ready to turn this into a swing trade. And now instead of a zero point 0.5 frog box, what I'm going to do is I'm going to keep 50 shares. I'm going to sell 450 and just keep 50 shares. And now that's like a 2 ATR adverse stop for you.
Right.
And now, and then if tomorrow this thing resumes, I could put my 450 back on without having to do any kind of detailed
Math.
research. Yeah,
Right.
yeah. So so here's how we've come to understand understand this idea is that for the day trade, if I'm going to be a core and a little turbo trader, right? That means I am really trying to be a swing trader, and then occasionally I see a chance to do an intraday swing. But I might be a little C, big T guy, and I'm going to do swing trading one day at a time. And all I'm going to use the swing trade for is a signal that this thing is in play for the next 5 days, and that I can look to find an advantageous turbo trade from some number of pre-prepared stocks. Like I could treat these as continuation patterns, even if I decided not to carry any overnight risk, simply because today was a good intraday trade for it. So I think tomorrow could be another good intraday, but there's no reason for me to take any overnight risk because it turns out that the size of the gaps on all of those are significant.
Right.
Like silver will adverse gap 5%, and that'll get your attention. So rather than just monkey around with that at all, I just say I'm tracking the swing trade. Silver is generally up. I'm tracking the swing trade pattern for it. I'm just not carrying live swing trades shares, but I'm using the swing trade pattern to keep these things like UMAC. That's unusual machines. The only reason that's even a thing is because Don Jr. got appointed to the board so that they could pay him a couple million shares at a value of $2 a share. And as soon as it was trading between 1 and 3, it had a little bump to 4 a couple times. And then here they announced Don Jr. was on the board. That thing went from 4 to 24 in 2 weeks. And then it came down, down, down to 6. So I look at that and I say, with the rule of 4, now what I'm going to do is I'm going to show you a technique that we're using called the rule of 4, which you will see in all of the coaching sessions. That I just take a frame and say, that's the swing, that's the high, and this is the low. Let's just call that 4, because that's this. I know that that thing trades in a range from 4 to 24. This was the maximum naive optimism that it was going to go to 50 or 100 because Don Jr. was on the board. And if the United States ended up going to war against people like, oh, I don't know, Venezuela, Canada, Mexico, Greenland, the entire European Union, and our former NATO allies, and Nigeria, and China, and Russia, to divert attention from the Epstein files, that thing would go even much higher because they're going to get all kinds of Department of Defense contracts for American made robots for war. That's what UMAC does. In the last 2 weeks, Trump has talked about taking the Department of Defense budget from 1 trillion to 1.5 trillion. Where would those $500 billion go? To the kinds of companies that could rapidly produce the vehicles of modern war against our former allies, like robotics, drones, the kinds of things that UMAC can produce. So UMAC, and then there's a whole bunch of other little small companies that are in that same category of war crimes. There's a half a dozen other symbols that behave like that. But for my purposes, UMAC is sufficient. So the rule of four says you take the highest high and the lowest low of the channel that you've defined, cut it in half, cut it in half again, and then when that thing is in this bottom region, it's oversold. And as long as it holds that support, you can what I'm looking to do is find a tactical price pattern that's showing that. And anywhere that I can buy it in here, when there's tactical upward momentum, then my actual risk box is really pretty small. Even if I can just buy it in the upper half of that region, my risk box is pretty small and my rewards are very large. That's the general template of the rule of four because I've got one unit of oversold, one unit where it's overbought, and then these two in the middle that are kind of just the normal mid range. Now,
Right.
as I'm designing the strategy for that, I can actually go back and take a specific look at um, support and resistance and turning points in the RL10 and the Dragon, and I can project that over and say, look, this is going to be a test of that Kata 2. Like this was a Kata 2 in here for a moment
Mm-hmm.
because it had a higher low, but it could only get this far before the sellers came in. And then this was a Kata 2 on the downside, but that support didn't hold, and that became a collapsing dragon all the way down here. So I can actually bring both of those prices over, and I can say for that symbol that this little region in here is probably special. That whole thing is a like a resistance level. That if it ever broke out of that, then this thing would be free and clear.
Check.
But that also
Okay.
allows so if I could buy it here,
Mm-hmm.
then I could get two easy ones and then maybe a third one, and I can use money management and position sizing and timing intraday to get my intraday move, but also keep the larger swing position in mind about the strategy. So I've used that strategy in UMAC for about 9 months. And as a point of reference, um, that's a 30-minute chart. So if I look at the daily chart on that thing, just since October, this thing has gone from between 7.5
7.5.
to 19.
Oh my God.
Yeah, you know what I mean? And
Yeah.
and there's the channel. This was 24.
Oh wow.
So this thing went from 24 to 6 to 22. Here's where it really found major support. So 5. When this thing broke above right about here, 6, it's never really so if I were to update this, I probably only need to say from 6, and I would have said to 17, but yesterday in the last 2 days It even broke from above that. So you can see it's in rarefied atmosphere right now. So why am I going to be ready to trade this thing on Tuesday? Because this is either free and clear and there's nothing to stop it until it gets to 22 or 24, or this thing is going to sell off harshly. And then I would say, how far is that going to fall if it starts failing? Well, it's going to go to 14 to this little piece, or it's going to come down to this little piece, which had support here, so 12. And then if that fails, it could come all the way to 9 and then 7.5. And if 7.5 fails, it comes. So I can build these little price regions that are multiple dollars. But then if I come over and look at, I come over to UMAC, and now I say the frog box in this thing. Let's see, where is he? R10, R5. The range stat is a buck 30. So I thought I had the frog box
The
on there.
range that it says a buck 89.
Oh, buck 89.
Yeah,
Oh, I misread that. I'm sorry.
that's fine.
I read that as a 30. Okay, so call it $2. So the intraday move is $2. So if I'm just on a 10-minute chart on this thing, here was yesterday. That that line is yesterday's close.
Mm-hmm.
Uh, if I waited to see if I wanted to get a 1, 2, 3 on that, my entry is here where it breaks through the 30 period red PSAR dot, which is also above this last little SMA or the RL30, which is above the previous two peaks of the RL10. I mean, I could put legitimately, I could just say, put my stop at the PSAR flip, right?
Right.
Which is at the belly of the RL10. So my actual risk box would be
How big? Um, Less than 50 cents, correct?
50 cents,
40 cents, which is what percentage? Is this
which is
type of
one.
a fraud box?
That's somewhere around a frog. That's like a quarter of a range stat. Hey, instead of monkeying around with the frog boxes and all that, if you use now I'm going to tell you one of the easiest ways to do it is just take the range stat and
Mm-hmm.
divide it by 4, right? Because that's the maximum reasonable intraday move. So if it was a buck 89, let's call it $2. Here's my 50-cent move off the low of the day. I could have bought that here,
Right.
probably probably right there. Now, this is where I would say you don't have to be uh, religiously committed to that. You could say, hey, I want to see it get above those two peaks of the RL10
Sure.
and say, you know what, I'll buy this. Or you could say, I'll buy the RL30. Here, see this green line right here?
Yeah.
That's
Yeah.
that's the 90-minute regression line, the moving regression line. You want to trade in the direction of that,
Right.
and a lot of times when it's front running the 30 SMA,
Correct.
you're ready to buy above those two humps, and
Correct.
so you end up either buying here or not later than there.
And the RL30 turning up, and I mean, that's been such a confirming.
Yeah, that's your owl. There's your RL30 turning
Yeah.
up.
Yeah.
So
Yeah.
your owl entry is that's a kata two. This is a emerging dragon, and now here you are, right there,
Right.
and that is one, 8 bars. That's 80 minutes later. So here's how I do that. What I'm trying to do is talk you out of reading the daily report every day, or I'm going to tell you to look at one page.
Oh, okay. I didn't know where that was going.
Yeah, that's where we're going
All
on
right.
this.
Okay. I get it.
It's simpler than trying to figure out how to integrate 30 different symbols. So what I would do is the intraday looks something like this. Where's my stamp and my, yeah, I think is it
So
this one?
far we've covered a lot of material, but you going back to the report, you start with you're carrying over positions from swing trading. Those are obvious targets. Then you
Yeah,
see the special circumstances on
yeah,
any swing trade.
yeah.
Those become focuses, and then you also consider the large gaps that morning for whatever news. So those
That's right.
three are your selected group of symbols that you are targeting. So let's say we're talking
Trade.
about 15, six targets, five special situations or whatever, and then a few
Yep,
gaps. So there's 15. And then you open up the day with your core swings, obviously, makes sense. Or maybe
yep,
you want to maybe incorporate one more. And then you start placing trades in the first few minutes, and then you start actively doing it.
yep.
And then what happens next during the day after the first flurry of the first 2 hours? What does Ken do after the first 2 hours?
I look for all the ones like on this one. This is where the
Yep,
keep 70
yep,
works. I end up
yep.
getting I get that exit.
Perfect.
So let me say out. We'll say here. I look at this and I say, where's my drawing?
Three to
Now
one for
now all
trade.
I'm doing is I'm managing turning points in the RL10.
Makes sense.
One, two, three.
Kata two, almost.
And my execution stop on that is going to be the standard position size. But I wouldn't stick around longer than the break of that red dot because that is the PSAR that's directed by the 30 period regression line. The black dots is a PSAR based on the RL10,
Mm-hmm.
not the price. And
Mm-hmm.
the red dot is the PSAR driven by the RL30,
Mm-hmm.
which is why you see they are so smooth,
Mm-hmm.
and which is why that piece right there did not cause the PSARs to flip.
Right.
Now, if my I would still take that exit, I would take that save 70% exit where it was because of the unusual burst of buying activity that drove that thing so high so fast.
Correct.
But what if we didn't have that bar? Like if that bar was not there and maybe it was like this,
If the
uh
peak would have been at $8, yeah.
yeah, then this would have been like that.
Yeah. So
And yeah, I
you would have
probably
profit
end up
taken and
getting,
re-entered.
yeah, yeah. I end up
Great.
whoops, oops, sorry. Like when I have it on stamp, it automatically hits the stamp
Sure.
multiple times. I forget. Yeah. So I gotta. So my 70% stop on this one would have been there at the
Right.
leading edge. That's a 1, 2, 3 exit the other way,
Right.
and I'm happy to. I just look at how much of the. Here's the mindset you have to have for this. The shape, what you think about the risk is different than what you think about the reward. All
Correct.
right. When I'm calibrating the amount of risk that I can manage against that how many units of reward to the upside is there reasonably available? That's my rational mind making that calculation. And that justifies rationally taking the trade. But I'll tell you, when I talk to my wife, she didn't care any about all that. She says, okay, you got in. And the only thing she says is, on your best moment in the trade, how much did you have? And I tell her, and she says, how much did you keep? And I say, well, you got to understand that here's how, and she says, no, 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 no. How much did you have? Max favorable excursion. How much did you keep? And I say, I kept 70% of the maximum favorable, more than two-thirds.
Correct.
I gave it 30% room to run. And then in this case, the reentry is still in the same position. It's still a cotta two. The
But
slope of the RL,
that
yeah,
boils down to the concept, which I love your concept of the 70% boils down
yeah,
to recharging your emotional battery
yeah,
and adding capital to that and not draining that.
yeah.
Uh,
Well, here's part of the. There's two reasons that it does not drain your emotional capital. Number
mhm,
one, uh, mathematically, you're keeping most of what was there. You made the trade on the basis of what you thought could reasonably be there, but we have no idea what it's actually going to be.
correct.
It's after the fact, after the thing is rolled over. I know that wherever, if I get out at the keep 70, I gave it the maximum reasonable. I gave it the maximum amount of room that I could give it and still feel professional.
Correct.
Now, if that had been like a 15R win, I might have nudged it up to keep 80%.
Correct.
But, that's a good problem to have.
Correct.
But most of the time, keep 80%, you end up getting ticked out pretty quick. And I like to wait and see the RL10 roll over. But if I ever saw one of those asymptotic moves where price moved well ahead of the RL10, then
Right.
I just start after 2R, I just put that little gauge on there and just keep dragging it and I know where the keep's at. So number one, I don't have an emotional drain in hindsight saying, "Oh, I wish I had, I had a
Correct.
rule and I stuck to it and I feel professional." And the fact that I did it professionally adds to my emotional bank account.
Correct.
Now,
And that is crucial. That is
yeah,
crucial.
now here's the second thing. I spend zero energy calculating
Correct.
multiple different exits and what about this exit versus that? Well, what if I take half with this and then half with that and then carry
Correct.
the forward to it? No, just keep 70. Here's what I'm actually at the point now. Once I get to no lose plus dinner for two,
Hmm.
I monitor it until it gets to 2R. I put the keep 70% or exit at the close and leave it alone. Don't even look at the chart.
Perfect.
Zero emotional investment. Now, if it alerts me and tells me it exited, I bring the chart back up so I can see what I got. And if there's time left in the day, like on this one, I can COTA 2 reentry. So here's the COTA, here's how that COTA 2 shaped out. You anchor that to the entry point, almost to the dollar. Look at that.
Hmm.
Probably on that bar or this bar, one of those two. The spine of the dragon, essentially. And so I don't, now that will calculate out as if I base it off the size of this particular yellow box,
Hmm.
I could, but you know what's easier? Just calculate it off your 50-cent standard exit, your standard block. And
Okay.
that just means I was never going to take even a full 50-cent loss on this one.
Hmm.
I was going to take a 20-cent loss. And then the 50 cent, this was about a 50-cent move. So at the end of the day, that's a 1 hour trade. Take that all day. If you,
Absolutely.
if you, if you, uh, if you over, if you work hard on the little details, you could say specifically, this was a 20-cent risk and I made 50 cents. So it's a 2.5 R. That would, yeah, but it's standard. Remember, the size of that position is the same as the size of this position. So here's what I want to do. I want you to have the problem of figuring out how you want to compute R's. I just do it off of the 50 cent. If that's my standard risk now, a quarter of a range stat, done. If you start trading those things and you start saying even that box feels a little big, divide the range stat by 5. Now you have the rule of 5. You know why
Which is
that's
the
even,
hybrid frog.
yeah, the rule of 5 is kind of even better because you
Right.
give it one box and now you got 4. And if
Right.
it just goes halfway, you got 2. So you could sell half and keep one. So that actually works out really, really nicely.
And it boils down to expectancy. It boils down to how many,
Yeah.
R's,
Yeah.
true R's are there within the
Yeah.
day in the range type,
Right.
and that just amplifies.
So now you're going to track two separate measures of effectiveness. Number one, you're going to track the pure R capture,
Correct.
which in my view is entry minus your execution stop. In this case, the execution stop was, I'm pointing with my finger. The execution stop was this one here because that was the price that was going to get me out.
Okay.
Uh, and then so you're going to track just the R capture, and that's entry minus I stop,
Okay.
I stop,
So yeah,
and
the
then and then and then
execution,
and
the
then and
R.
then you have your exit. So that tells you how many of your execution risk boxes you captured,
Okay.
and that will give you the expectancy of the quality of the pattern in the rules, independent of position size.
Right.
Clear?
Correct. But
So
then
it
you
didn't
need to
matter whether
adjust.
you were,
Yeah.
yeah, you were trading 1 share or 1,000 shares. The rolling expectancy is
Right.
telling you about the current quality of that signal in the current market.
Correct.
So that's the R expectancy. The second thing you do is you keep track of dollars.
Correct.
What did I take home? Now here's what will happen. If you think back to when I was talking about market conditions,
Hmm.
that sometimes I will vary the size of the dollars at risk on the basis of market condition. One of
On the
the
swing trades.
yeah,
On the swing, not on the intraday trade. Correct.
right. This would be the market condition of like the risk Z
Yeah. Yeah. Yeah.
or
Yeah.
bullish,
Bullish, normal,
yeah.
bullish, volatile. Yes.
But here's the double secret. Although that's useful, the actual market classification you want to use
Right.
is the slope of your R multiple expectancy.
Makes complete sense.
Yeah. So let's say there's a seasonality in the way I'm trading this thing. And on its best days, it's the R multiple expectancy is up here, and then it's down there, and then it's up here, and then it's down there. And even if that was a flat line, and I put plus or minus one standard deviation on it, I could go if it's positive expectancy system, I should always be trading it with live money.
Right.
even if it's $1 or one
Correct.
share. But when here's the midpoint. So if we were to use the MACD histogram four seasons approach, we would call this from the zero line and positive slope summer,
Right.
above the zero line but negative slope fall, below the zero line. Now it's actually negative expectancy, winter. So I should not be live trading that one. And then below the zero line but up, that's the spring.
Hmm.
So in the spring, you want to be on full position. That should say full. Yeah. And then in the
Hmm.
summer, you want to be on full position.
Correct.
In the fall, you want to be on maybe half a position. And then when it caught a twos, full position.
Yes.
And in the winter, you want to be trading one share live or only take the failure patterns. Now, this will end up causing you to vary the dollars at risk per trade, but it will not change the architecture
Correct.
and geometry of your trade.
Correct.
What I notice that guys want to get larger in the THARP style is they would say, "Well, I always want to risk $400, but I'm gonna, in order to get $400, instead of having a 50-cent stop, I'm going to use a 25-cent stop." I argue that the location of your stop should be geared to the hypothesis of the trade. This trade
Right.
right here says the dragon has reversed. It had a well-defined low, a higher low, a successful trade, and it is above, it's getting ready to break above this support level or resistance level. So
Right.
if it breaks above here, it can go as high as a range stat, which is the low of the day at 17, plus $2 is 19. Hey, what we saw right here, that was a one range stat move. So
Yep.
I say you put the execution stop where the hypothesis of the trade is invalidated, but you use your full frog box for your standard position size. So you never get large, even though the tactical risk box is small, like you want it to be. You're not going to suddenly make that three times larger position size because that's the one that's most likely to fail. Why?
Yeah.
Because the last time it only got that far and failed. But if I wait for it to get above this, now my reward potential is only this and not here.
Right.
So I have to make a trade off in there somewhere. So you want to track your R multiple expectancy independent of position size. And then you also want to track your equity curve.
Correct.
Now, if you do that the way I showed you with the varying the dollars at risk per trade as a function of market classification, you can get started with like the risk Z and the page one. Like right now, we are in bullish normal conditions.
Hmm.
You could use that to guide your size. Eventually, each strategy that you have, each specific rule set achieves some kind of rolling R expectancy shape. And what that is reflecting is how well aligned your system is to the current market. In other
Right.
words, the shape of your expectancy curve is the market classification for that system. And you'll get to see what was the best day ever seasonally. What were the worst days? Is it a rising slope because I'm getting smarter at how to trade it, or the market's moving in my direction, or the symbols that I'm selecting are better suited for that kind of a. So there's a bunch of reasons why, I'm not waiting too long to get out now. I'm re-entering sooner, you know. Uh, so there's a number of reasons why you could get improvements in your R multiple. All that means is that it is well suited seasonally to trade in that market. That's better information than the conventional way to think about market classification is to say, well, I have a system and it should trade well when the market in general is behaving like this.
Right.
And so then you check that out, you say, yeah, it seems to be true. And so then you only choose the system that should work in that kind of a market. What I say is paper trade all your systems all the time. And when the expectancy curve goes from winter, when it was horrible, to spring, you start getting bigger.
Right.
And somewhere in the spring, you go to full size.
Right.
Maybe it's halfway back. I don't know.
You're describing it in a different way that I've conceptualized it. What I've seen
Yeah.
it running a business.
Yeah.
I've separated into three buckets. I
Yeah.
separate the minimum, the lowest,
Yeah.
uh, conservative position sizing account
Yeah.
based on meeting three goals. The first bucket is the cost of doing business. There's a cost that you need to meet on a monthly basis to
Yeah.
keep the lights running.
Mm-hmm.
That's one bucket. The second bucket is a little bit of the desired minimum desired performance return. And then
Yep.
after that second bucket is full, then the turbo starts
Yeah.
with
Fair enough.
which is exactly what you're describing. It's a positive equity curve within the month, and then
Yeah.
if the month is 15 days in and everything's working as it should or whatever, then the turbo kicks in with
Right.
the market's money.
Right. So the imagine the edge case where you were in a position where you had taken my advice and you were trading one share live, so
Mm-hmm.
you get actual real data.
Mm-hmm.
And you say, for the last 30 trades, this
Mm-hmm.
thing has a positive expectancy of zero point 0.4, which is really
Mm-hmm.
good. But the overall market classification is, sideways volatile. So
Mm-hmm.
the system should not work in that kind of a market.
Mm-hmm.
So should I trade that system because the market classification theory predicts that it shouldn't work? Or should I trade it because the actual evidence of my eyes shows that it's working?
Right.
B, it's working.
Correct.
Who are you going to believe, me or your lying eyes? So
Correct.
there's reasons why those things happen, and it's usually because the symbols that you were trading had something special going on that was more important than the overall broad market. And
Right.
as your symbols begin to move away from strong correlation with the market, the more likely the special circumstances are that justifies the trading of them, right?
Right.
So, and then you just got to recognize that target selection for your system now becomes important. You have to blend. How important is the market overall condition to me, and how important is the um, signal and system information? And it starts to get to be more of the signal and the system as you start to specialize. Now, there are some things about the market, like right now, that orange skinned monkey could decide to launch troops into Greenland tomorrow.
Right.
That would, I don't care what system you have that's positive expectancy right now, its performance is going to change if that were to happen tomorrow, because that's a case where the market news is so substantive that it changes everybody's behavior regardless of their system. You would see systems that were formerly uncorrelated would suddenly become correlated in a hurry. So
And
there's
you've
always some of
expressed
that.
you've expressed before your own experience of how you have shifted from more core and more swing
Yeah,
to more intraday based,
yeah,
and so you already know the answer to that. And what is the
yeah,
answer? What is the answer to what favors more intraday?
yeah. I right now I am 20% core, 40% swing, and 40% day.
There you go.
So the 20% core is like always invested no matter what,
Right.
and using the BMR and something like that. The swing is at 40% exposure if and only if every symbol in there has justified position and is still in the market. Like I have 40% of the capital allocated to it, but I may not have 40% of it employed.
Correct.
And what I may end up doing is if I get nervous in the service, I might have half of it employed in swing trades and then take the other half of the swing money and move it into the day trading as a hedge.
And in your experience, what has been the highest allocation or the lowest allocation to core and swing in your
The low,
experience?
I've never really gone below 10, uh, well, 10
On
of the
core,
20
on core,
in the core. I'm like always 50% in.
swing.
Yeah. And then swing, I've gone as low as uh, perfectly flat. So zero committed in either direction. And I roll that 80. And my rule of thumb is if I have money in the swing portfolio, I'm day, I, I am always day trading
And in your
every day.
experience, what market classification has, or what
Volatile,
mark
any,
volatile?
yeah, any volatile
Okay, makes sense.
and any quiet.
Makes sense.
Yeah, because that's where because only 1/6 of the in my classification system, only 1/6 of the time is it quiet, and only 1/6 of the time is it
It's volatile.
volatile.
Okay.
If it's quiet of any type, let's see, if it was bear quiet, it does not stay bear quiet very long.
Hmm.
It cannot. The bear is either going to come back for a second helping, and that's going to be violent, or there's going to be steady pressure to buy, and then that's going to move it from quiet into a directional move. And the way I calculate volatility, the bigger the directional move, the more volatile it's becoming. So it does not stay in bear quiet very long. Bear volatile is my favorite time to trade because you're either going to have these huge intraday sell-offs and it's collapsing dragons all the way down, or you're going to get reversal days that are 1 day only, like dead cat bounces, and you get the amazing melt up, and then there's no follow through the next day. So I get the melt up and then step aside, you go to sleep. And so in bear markets and any volatile market, I am mostly a day trader plus 10% core or something like that. So the swing,
Perfect.
this what I would like to do. I mean,
Hmm.
I would like it to be the only time like I ever get into all swing money,
Hmm.
fully committed to swing trades is bullish normal and bullish quiet because it's just been grinding, 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 grinding. And the swing trades are coming and I get fully invested and I get focused on the ones that are leading the way. And in that kind of a market, I'll end up having full exposure in the core, 20%, and full exposure in the swing, 40%. And then sometimes those swing positions will be in leveraged symbols like GGLL, so a double scoop of Google, or it'll be in UDOW, which is the triple Dow Jones 30, because
Hmm.
why not? Um, and so it'd be 20% in the core, 40% in swing, and then the other 40% is cash overnight and ready to trade price in the direction tomorrow with an eye on. Now, if I was fully invested in the swing, I know what I'm going to be paying attention to for the intraday trade. I'm either going to be just piling on those with turbo, or I'm going to be taking hedge positions to protect the core position or the swing position. So at least I can neutralize the loss of the swing trade portfolio.
Makes sense.
So it's like uh, if the long-term buy and hold, as you know, works because the market is slightly tilted up and the
Right.
bullish returns pay for the bearish results. Yeah, but what if you're the 60% of your core and swing only went up, and then on days when they would lose money, they zeroed out? A 60% exposed portfolio like that would defeat 100% buy and hold.
Right.
And so the 40% of the day trade money is simply looking for these kinds of low risk opportunities. Find the movers, find the most volatile ones, keep 70%, lather, rinse, repeat, preserve emotional resilience. Do not pay attention to news or anything. Just trade the couple patterns and whatever's that you got. What I really want you to do is study Eric Moe in cohort 4. He's had 10 months in a row of no losing weeks, trading exactly this way with about a dozen symbols. He's got about anywhere from 60 to 70% win rate in a given month and a payoff of 3 to 1. That's it's uh it's almost boring for him, which is where I want you to be. So here's what I'm going to say. The way I think that you should use the daily report would be to adopt his approach to target selection and pattern selection, which is what I just showed you, and the rule of four, and intraday position sizing. We're calling it the Hogard press, uh, and relentless attention to detail on a dozen symbols. And now you would use the daily report to find, your range stats or look for, once in a while, those 12 signals or symbols will have a swing trade fire for them.
Right.
But what he's really looking at is the way I just shaped this chart right here was putting the let's call it the hybrid frame on it, the rule of four or the rule of five, and just he's using 10-minute charts and 3-minute charts. And then once the thing is moving well on the 10-minute, he shifts to the 30 and lets it kind of grind. And I've been telling him to do this thing with the once you get past 2R, put the keep 70 on it and turn off the chart. Keep 70 or exit at close.
All right.
And that's the best way, I believe, to use the daily report is to identify those story stocks, the high payoff intraday, the frog candidates. I show like the top 10 or 20 based on it's a combination of the frog quality number. You want a high frog quality number. Oh, wait a minute. I should just show you now that we're there. So this was the total weekend report. So the page I want you to look at is on the daily report.
Right.
Let's see.
Rigetti, Bitcoin, Intel, Palantir, Oracle, Tesla, Devonaut, Koa. Yes.
Yeah,
Page 32.
yeah. I gotta slowly get my way there. This one, these two are not bad. Like the tactical summaries will give you a quick look at where is the who are the winners and losers, and anything that's breaking out in their NDXs, those things are on fire.
Hmm.
Like industrials, we should go look at them. Real estate and uranium. Hey, that's the opposite of tech. The auto framer is always interesting because you get like you should always go look at Microsoft when it's 4-1.
Right.
I mean, you know, this one is nice because you can see the ones that have a good trade frame, but also are squeezed. So Exxon Mo XOP, um, Nike, if
Hmm.
you had to, but even that's starting to go uh, wider search than what I took when we're working with Eric. He's got a dozen symbols. He just looks at them. Um, let's see. This chart is an extract of that TC2000, and you can find the range stat of these are the ones the charts that I look at every day. That's my that's my day trading list for reference. But I day trade maybe a quarter of them. A lot of them are just once in a while there's a swing trade that's interesting, and so I keep it in there for reference.
Okay.
Like EWA is Australia, way down at the bottom. EWA is Australia. It's rare for it to come up as a swing candidate, but it sometimes it does. Let's see, where is the one I'm looking for? There it is. That one right there. Yeah, page 32.
32.
So the range stat percentage is more important than the range stat number
Hmm.
because this gives you the ability to compare between symbols. So that tells you right now that Rigetti, RGTI, which is a quantum computing company that is extraordinarily volatile, that's one of those story stocks that's like UMAC. If I find Rigetti in here, let's just see what that guy looks like.
Wow.
Yeah. So this thing went from 15 to 70 or 60, and then 60 back down to 25. And now lately it's been in this kind of this channel,
It
this
looks like a
channel right here.
C3 compression.
Yeah, that's exactly what it is. So,
It looks like a huge C3 compression. Once it gets out of that triangle, it's gonna go.
right. So there's that little 10-day high right there is 27. And then if it breaks, it does a PSAR flip at 29. So
Hmm.
basically, you could just put a buy at 30 to be your third position.
Right.
If it ever got above 30, I should be in it anyway. If you go to the peak of the RL10, it's yellow, it doesn't show up that well. That's 28.50.
Hmm.
So you should put a position on at 28.50 and another one at 30 as your last two positions. And then meanwhile, just intraday trade it. Now, it's look how large those things are consistently large. And it moves 11%, 10.59% of its price range every day on average.
And that's comparing the recent daily bar to the other bars. The recent daily bar looks minuscule compared to the other one. So that
Yeah,
means that thing, once it
except
gets
what it
going,
is. Yeah, except what it is it's if I look at the and I'll compare it to like AMD is at 4.5%,
right?
which is for a large cap company is still quite a lot. But Walmart's at 2.5%. Microsoft is at 2% of its daily price. So Rigetti is trading its normal range is 11% of its price. So when I look at Rigetti and I go, let's say, to the 10-minute bar, that thing is trading, between 26.50 and 24.50. That's a 10% move intraday.
Wow.
So this is how I trade Rigetti. I just wait for the something during the day like this. Whoops, let me get my circle in here. I just look at these peaks and I said, here's the VWAP, that orange line.
Hmm.
Where's my thought? And I say the range stat on Rigetti is $2.70. That's 26.50. So 24.30 is the maximum reasonable intraday move. So if it got down to 24.30, not allowed to be surprised. All right.
Right.
So I can look at this thing and say, we're now, oh, I'm sorry, that's a 2 day chart. But even at 2:30 in the afternoon, it's got to make a move to come back to the VWAP so they can get out of their leverage positions. And from 2:30 in 90 minutes, it moved from 26.20. God dang this pen.
224, 60
26.20
something.
down to 24.50.
Wow.
And if I'm trading with say 50 cent, a 50 cent box in that thing is this big. So I could put a 25 cent box on that and say I get a 1, 2, 3 entry, or when it crosses the VWAP, there's my risk box to the high of the day. I can get short right here at the V when it crosses the VWAP, and I get that whole move. And so this thing moves like that all the time, and I only got to get a dollar move out of it intraday. At after a turning point, the reversion to the mean trade is what makes this son of a gun interesting.
Right.
So when it comes to reading the report, I think what you should do is spend time listening to um, cohort 4, Eric Moe's discussions and the diagrams we're working through his charts, because you'll see us talking about these kinds of trades intraday on those story stocks. And then when you go to the daily report, there's 10 symbols for you.
Right.
Or reach out to
Perfect.
Eric and say, hey, give me the list of your 12. I'll If you want me to, I'll have him send you his rule set and his symbols and his prep. It's a one pager.
Sure.
And then that to me is the way to use the daily report for that particular style. You should you should decide what symbols you want to track for reasons that work for you. That's kind of what he did. But then when I come back to the daily report, this is the weekend, but it starts up, page one is the same on both. The very first things I look at is what's the nature of the market right now? The very first thing I said, okay, bullish normal. Um, it's bullish normal, so regular things can apply. There's been over the last 2 and 10 days, there has been some weakness compared to the long term. Risk Z is really worried. This is the Trump effect of Greenland. So that favors short term intraday trading. This is prime time for short day trading, short side day trading. The symbols that are strongest are the BMR symbols.
Right.
These are the guys that have money to protect: silver, clean energy, emerging markets, Latin America, small caps. The ETF2 weekly system is fully invested. So that means all 10 indexes of the world have been pretty good. So that thing is ripe to get punched in the face for sharp intraday moves to the downside. Not allowed to be surprised about that at all. If it
Hmm.
continues to grind up, you already know who's winning.
Right.
They're winning. Easy. Um, Now, if I go this is the daily chart. This has been buy on dip up. This was the Kata 2 to the downside, held support at the RL 150, could not break a new high, and that's still pretty much the case. This was questionable, but it's been holding at higher lows. So this pullback right now is the real test. The routine move should be held support. But notice for the longest time, the 30 SMA and the 90
Right.
were well above the 150.
Right.
I'm sorry, that's the 270. But all that is coming to a dude. That is the
That is the
Mac.
definition of a super pinch,
You're
extreme
not
critical
you're not
condition.
bullshitting. So anything
Oh
above
my God.
this or below that is
Yes.
down we go.
There's your weekly risk box right there for a monthly trade.
Yeah. So you just so
My goodness.
so that's pretty handy.
It's compressing big time.
Yeah. So now if I go to let's see, erase
Critical
my
decision moment for the market.
now this is just you this is the same chart but used in 3 days and 5 days. So
Hmm.
it looks back much further. And you can see that what we have is a doji that's weak because the close is below the open. And it hasn't really been able to make much much gains, but big sell, medium sells, micro sell. So for right now, the spine of the dragon is holding. The two PSARs are holding. But this thing right here, so the the 90 period is a regression line on the 9 day bar. That's the 810-day regression line, believe it or not. Even that thing is now coming into question. So we're at an exhaustion top, and between now and the 2026 elections,
Midterms, yeah.
what else is left? There's going to be he's going to fuck around with the Fed, and he's trying to put us at war with Denmark and NATO, and NATO is deploying troops to Greenland to battle the U.S. right now. I can't believe, as a retired Army officer with a 45-year career, that I'm saying those words. Unbelievable. So this one is just showing the same thing, but on daily bars. That's the 30-day. All of the so it's a grinding bull. So you get a lot of things that are above their 4 month moving average. This one also shows you week to week who are the winners. That's all internationals.
Hmm.
There's U.S. tech and treasuries are just horrible.
Right.
And then if you expand it to the sector spiders, yeah, healthcare, industrials, and energy. So it's not the tech leaders. It's really Main Street. It's not tech and basic materials. You don't get tech until it's way down here. So this is not tech in the lead at all. So that's favorable for all the story stocks that, those intraday guys that were high
Hmm.
volatile. They're still likely to be jumping. If you add other indexes in the world market, you take a look. Oh, silver. That's one of the reasons you pay attention to the longer term stuff. Silver's up 130% in 6 months. That's unusual behavior. So silver, Latin America, clean energy, gold, Mexico, Brazil, emerging markets, healthcare, Russell, Japan, industrials, energy, European 350. It's the top 13 before I even get to the first, US mid cap. So this is people are worried about changes in the posture of the US as a leading candidate in the world. That's what Trump has been able to manage to. The Dow
Yeah.
30, I like this one so I can start zeroing in on interesting movers. Like Boeing for defense has probably already shot its wad. 5% this week and 20%. That's a response to war. Honeywell to the same extent. Great company. But Microsoft is so bad that you have to start thinking pretty soon that it's a candidate. And it's 4-1 on a swing trade. There's probably a value play in Microsoft happening soon
Microsoft did
and has a
a
dividend.
AC3 pinch back at 500 that if it breaks and continues to the downside, I think
Yeah.
the 10 time move target 350 if I
Yeah.
remember correctly.
Plus, plus
It is
it'll
very
get
weak.
plus if the S&P gets punished, it'll get punished. So that's where I just make a note to myself. If the S&P is down and Microsoft is worse, I can short Microsoft's intraday. Make sense?
Yep. Yep.
This is the global list of ETFs, the unconstrained list. They're all liquid, but it shows you it's all the international guys.
Right.
I look at the bottom, and these are the bottom 10 or 7 or whatever, and I like looking at the ones that are just getting absolutely murdered as a potential value play long term. Not trading them right away, but I'm watching them because the reversion to the mean trade will be good. This
Yep.
summarizes the world market model on the
Yeah.
10 key indexes. And I'm just looking for what right now, the EFA, that's the rest of the world, is better than the S&P. EFA is 17. USA is 15, 16. So the rest of the world is outperforming the US. Inside the US, it's small caps, mid caps, tech, and then the S&P is pulling up the rear. That's rare. That's real weakness. Um, Two strongest sectors are Latin America and U.S. small caps. Weakest sectors are Asia, less Japan, and that should read SPY. Oh no, tech is even worse. Sorry. Yeah. Um, yeah. So this is already. So I'm on. This is already starting to dilute your target selection list and getting almost too many strategies for what you want to do intraday.
Right.
And so you got to remember that whole report, although it's 36 pages, that is a salad bar that supports all the different clients I have that have different
Correct.
time frames and dimensions. I think what you need is page 32,
Right.
and that if you have the TC 2000, the calculator for the R5s and the
For the stats.
all
Yeah.
that kind of stuff. That's pretty. I think that's about all you need.
Yeah.
And then if you don't mind, he doesn't need to know your backstory unless to the extent you want to talk to him about it. But I think you should talk to Eric Moe about his specific rule sets and the what it's been like trading that for about a year now.
Sure thing.
And
Sounds
then
great.
I would also listen to cohort 3, where I talk with Hamad from Abu Dhabi.
Mm-hmm.
He is also a financial professional like yourself, who has kind of like recently moved out on his own for his own funds and is going through exactly the same process you are of identifying a robust system with enough expectunity that he can trade the things that he needs.
Right.
Uh, And he does a masterful job of calculating performance metrics like the R multiple and then the uh, equity curve. And he did some very good math because he is strict on the way he executes his rules. He can actually look at the emerging themes from his uh, data set. And what he was able to realize was he essentially just figured out how to use the slope of the RL10 of his R multiple
Right.
to develop a position sizing strategy that was tuned to his system's performance.
And
And the
exactly.
different and the
I agree.
difference the difference that makes is enormous. So I
I agree.
I think you should spend this next week or two.
Yes.
I would go back like about I said I think December. I would go back maybe to like 1 September or 1 October and listen forward. Uh,
Primarily for these two cohorts first, cohort
yeah,
three and
like
four first.
I think I would probably listen to uh cohort three. That's Hamad and Chi Weng.
Right.
Chi Weng Chong only does the rule of four intraday with a handful of symbols, and he's like silent but deadly. He just crushes it. Doesn't say much. It's just like Hulk smash. He's got his three or four symbols, a couple patterns, and doesn't matter rain or shine. He's crushing it.
Perfect.
He's working out of Singapore, so he's in cohort three.
All
And
right.
Hamad now Chi Wang is in about half of those. Uh, we only meet like every 2 weeks, but I didn't realize it was that late for him, and so I had him in Canada for some reason. But he's kind of on autopilot right now. If it's not broken, he's not worried about it. But Hamad and I have when he and I are alone, we usually have very interesting conversations about the business side of it and performance metrics and rule sets and that kind of stuff. And I think that would appeal to you sort of on a
All
business
right.
professional side. And he has gone from trading his own money to trading investors' money to in the last year or so, he was he got hired by a Canadian home office firm he was a prop trader for them. He did not like the way they were marketing and whatnot, and some business decisions they were making because they were feeling the pressure and were starting to take unacceptable risks. So he divested himself of that, found some more investors to double the size of his assets under management. And now this last one that we just did last Sunday was sort of like a year wrap up and had a lot of ideas about the uh, performance metrics and tuning your position sizing to the to performance. He's only trading a handful of symbols, but he's got good data and good rule sets. His rule sets are similar to what Eric is using, but Eric is more active intraday and selecting from among 10 or 12 symbols. And he's been working hard on what we call the Hogard press, which is a way to trade those patterns I just showed you, but to quickly get positions in. So if you start listening to him from about October forward, that's where as memory serves, that's about 4 months, 4.5 months where we were really doing a lot of work with the Hogard press right there.
Okay.
And if you go back much further in time, it starts getting there'll be other systems and other issues and all that.
Right.
But I would start about 1 October
Okay.
with both of those guys, and you'll see some things that are very useful about the things we talked about tonight.
Perfect.
So what I'm going to do is I'm going to set you up your own coaching cohort in order to respect your privacy and whatnot. Um, it will be its own separate course in Rizuku, so it won't appear underneath the coaching program per se. But in the
Okay.
future, if you like, I personally feel like today's stuff I would like to share with them too. I
Yes.
don't think there was anything we revealed that was
Mm,
an issue
no, it's perfect.
that and so if with your permission, I'd like to put that in
Yes.
there as like a cohort 6
Sure.
or cohort 3
Yes.
and let them see it. And then and then as you watch cohort 3 and 5, you could sort of decide which one is like more aligned with you, or you could attend both. I get no problem with guys attending more, but at some point, enough is enough. You got to do your own
Right.
work too.
Right.
But
Correct.
but I'd be happy to have you join either one of those cohorts, and then for future, uh, only when you're satisfied that we're at production level on your side, do you got to worry about you'll be on scholarship until that point. Just because
Correct.
I want to reduce, I want to reduce every piece of stress that we can,
Correct.
and play for the long term.
Okay.
So that's what we'll do.
All right. Well, greatly appreciated for all your time and everything, and
Yeah,
I'm very happy to be part of whatever I can contribute.
yeah. So what I was going to show you, I have I was planning till about 2 seconds before I started talking. I was going to run through some of this stuff,
Oh yeah,
the generic material, like what we just said
I've
today
got
was
all of
that.
those.
Yeah, I mean we spent a lot of time talking
Yes. Yes.
just that, and
Right.
then just the next two I'm going to show you is I've had other guys that weren't sure if they wanted to be day traders or swing traders or position traders, and they were trying to figure out what to do with this giant report. And I said, well, here's a way. Uh, the left hand side are very specific rule sets,
Right.
and so you could go through and in the open space you would say these are the ones that I'm in. I'm just trying to identify symbols that I care about. And then on the right hand side would be as I go. Already heard me talking a little bit about that. Like, hey, uh, energy, industrials, materials are all surprisingly leading the way. You know, so I would put notes in there about the market, all the things we talked about volatility and Z3 pinch would go up there in the and the vol it would go up there in their market condition. Sector notes would have things like be mindful of the non-US weakness in tech, that kind of stuff. And then any other notes I would do. I could even go further and say, turn this into a prepare sheet where I take each of those symbols that I just identified and then manually calculate all of those things like after I framed it. Where's my entry, my initial stop, the initial target, what's my reward to risk? And then on the right third side of that, I would say, hey, as these things start moving up the stack, which ones of the ones I prepared turn out to be the four that I'm trading today? And I'm using, intraday dashboarding to try to find the movers from among the restricted number of symbols that I've chosen, you know. And I know you've probably seen this one before, the
Yes.
logic chain.
The logic chain. Yes.
Yeah, about how you get from indexes to these
Down
things that
to.
are moving and how you know how to leap back and forth. I
Hmm.
talked a little bit about the 1, 2, 3 entry for me is usually all I need to see.
Right.
Um, the doji is so important to me. For me, it's the open or the body of the doji is less than 20% of the daily range, and the daily range is less than 80% of the average range. So the range is smaller, and the actual real body where they're fighting over it is really tightly compressed. So I mean, there's that, and then the rest of this was just kind of generic pinch and stretch. This is where we get into that idea of the continuation patterns. This is
Hmm.
the intraday uh, continuation pattern. So wherever it opens, there's the gap opening. Hybrid frog up, I'm long. Hybrid frog short or south, I'm short. If that move to the short side was long enough, it could actually become an SSC or an
Hmm.
owl, which could then lead to an exit and then a kata 2 reentry until it stabilizes into a intraday sideways quiet channel. Or that initial collapsing dragon, that thing could fail for a reentry on the collapsing dragon a couple times. Or after the initial big move, maybe I never get any of those and it just dwindles into a sideways quiet channel to the point where it becomes a Z3P and is now tightly compressed enough that I can play the breakout. Well, that's nothing more than the pinch and stretch life cycle intraday using a zero point 0.5 frog box. That could also be a swing trade, but instead of a hybrid frog, that could be an ATR box. And all those patterns look exactly the same. They are fractal on every time dimension.
Hmm.
And then there are times where, when the market is very pinched, I'm ready to play the breakout and then the reversion to the mean. But if it's a very expanded range, like a 1 day bar, I'm ready to play the reversal from extremes intraday. So, to that extent, knowing where we are on the pinch and stretch is kind of useful. I'm thinking if there's any other words here that was not really. Uh, this one I would, what we kind of did with the S&P, and to a certain extent with those two story stocks, the UMAC and the Rigetti,
Spaghetti.
is when I'm thinking about really studying a symbol to make it mine so that I can do core and turbo at any time frame. This is about the sequence I go through. I feel I put
Right.
something into each box. I go through all the monthlies first. I start with the MACD histogram and four seasons because that's the quickest
Right.
thumbnail. And then I look for specific pinch and stretch conditions, recent moves, that kind of stuff, sharp turning points. I look for the RLCOA. What's the current pattern that it's in? Where are the turning points in the RL10? How far away is the RL10 from the RL270? How
Hmm.
many ATRs is that, or how many frog boxes? And then strictly support and resistance levels. Once I understand that for the monthly and mark up the chart, I lately I guess I would change this to 9 day, 3 day, daily, two
Right.
hour and 30 minutes, and then I get a comprehensive view of those things like you saw me do with UMAC and um, Rigetti. So that's kind of crucial. And then that trading pro every trade, any time frame, any pattern always comes down to this. What do you see? What could it do? Which way do you want to trade? How would you enter? If it you traded that way, where would you classify it as a failure? That's how you define the 1R.
Hmm.
And if it did fail, would you stop and reverse? The answer to that has to be yes, if you found a compound critical state.
Correct.
Because the definition is it had a large move reasonably available in either direction, and it's a coin flip. But even if you said that you could be in a compound critical state and then just made an emotional commitment to say, hey, I only want to trade this thing long because I'm not comfortable yet with the rapid reversal. So I'm going to go the first direction that it takes, but I'm not going to get caught up in the stop and reverse because I'm not ready to do that yet. That's legit. And that just tells us what we got to get to. We got to trade with smaller position size on this for the stop and reversal. And then if you actually do get a win, and let's call that a 2R win or even a 1R win, you say, well, where would it stall? Where would be the next logical resistance? How do I preserve the gains? I answer that with keep 70%. And then you look at how far back it could come. And if it comes all the way back to your entry, would it keep going? And so somewhere in that stack, you got to decide if you would ever stop and reverse. And I don't always do that. In fact, I usually don't. Because if I was long on something and it was an exceptional move, I'm invested in a kata 2 reentry rather than completely reverse psychology and think that astronomical winners are going to be replaced by astro. I'd rather go find something that's already failing and get short that.
Right.
And then if I did exit to preserve a win, and then it started reversing back in my direction, where would I re-enter? My standard shop answer to that is kata 2. It's
Right.
either kata 2 or an emerging dragon, and off we go. So I try to, whenever I have a standard piece of work or a template, then I can put that in there to make those answers easy. And then when I'm actually framing a trade, those are the questions that I need to answer for every trade. When you do that, you will have taken the emotional sting out of it because it forces you to look at the trade in both directions.
Perfect.
Yeah. So this is managing your internal energy state. That's sort of the usual stuff. Um, how you learn from your efforts. Yeah, that's probably enough for today, I think. So what I'd like
Okay.
you figure out the next reflect on this for 24 hours. Send me a note 24 hours from now, Monday evening. So there's no market tomorrow. Kind of reflect on this, get yourself a research and study plan, establish a learning journal in a notepad text file. What I want you to do is we're going to use AI coaching on this. We have have you accessed have I sent you the link for the 5 frames AI assistant coach?
No.
Oh, is this ever good? So that has 350 million curated words of every workshop I've ever taught, every book or report I've ever written, all of the research that any of the live trading research weekend guys have contributed, every coaching session I've ever done, all the research I've ever done for writing any of my books, plus a couple hundred other million words of curiosity, creativity, critical thinking, market psychology. The best 50 market psychologists, all of their books that are in the public domain or which I own are in there, all of their YouTube interviews, and all analyzed by Google's Gemini 3.0. And it allows us to query that data set,
Oh
and
wow.
it gives better answers than I give.
Oh
And
nice.
anytime anybody asks me a question, I always just run it through there to see what I would answer on my best day. So that gives you the ability to really 24/7 ask questions of the collective consciousness of our entire community of practice.